I'm the Deputy CEO of Calculus Capital. I've been with them for 5 years. By background, I'm a recovering investment banker. I did that for 25 years and find I'm using the same skill set at Calculus as I did in investment banking as an M&A banker, just looking at problems in a different way. And I have to say it's given me a whole new lease of life. My primary responsibility within Calculus is portfolio management and exits. The fact that we've got someone who's got responsibility for exits within their job title also says quite a lot about Calculus. And it's all very well collecting money from investors, but it's much more important to give it back to them as well with a profit, hopefully. Calculus Capital, what are we known for? We are tax-advantaged investors, enterprise investment scheme, and venture capital trusts. I'm not going to go into the detail of those tax benefits in this presentation. They are very attractive tax breaks. Just in great summary, if you invest £100 with us for EIS and our performance across a whole portfolio is so spectacularly bad, we lose everything. If you're lucky enough to be a 45% taxpayer, the net cost to you is only £38.50. HMRC give you the rest back. It's a spectacularly generous scheme and it's set up for investing in SMEs. What Calculus is known for, we developed the first HMRC approved EIS fund in 1999. As I mentioned, I'm primarily responsible for portfolio management and exits. I have other responsibilities across the firm, including organising a 20th anniversary party later this year. We've got on the bottom right there, multi-award winning. To my mind, our main credential is that we are just about to launch Fund 20. Private equity firms don't get to launch Fund 20 unless they know what they're doing. Irrespective of what awards we might pick up. And exit driven. On the current investment strategy, it's 35 exits with an average return of 1.8 times. Where do we invest? We're growth capital investors. And slightly strangely, the best way of describing this is to explain what we don't describe ourselves as. I've just managed to jump a slide. How did I do that? No. There we go. 2 slides. We are a private equity investor. We don't normally describe ourselves as private equity because people then think we do management buyouts, and we don't. We also don't describe ourselves as venture capital because then people think we do startup and seed and early stage, and we don't. What we do is the bit in the middle. If you're familiar with the concept, we invest in the equity gap. We're investing £1 to £5 million into companies that need capital to grow. And what we're really looking for in companies we invest in is those that have not only developed a product, they've also got sufficient commercial traction to have a demonstrated product market fit. And we're giving them the capital they then need to grow from turnover of, say, £1 million to £10 million. That's what we do. I suspect I'm going to need to speed this up, aren't I? If you look at the slide there, on the left-hand side, you've got, we're creating a diversified portfolio with a very robust investment process that any private equity firm would recognise. On the DD side, due diligence, as well as the normal legal and financial and potential intellectual property due diligence. Other things we do that you might not expect to see is we do commercial due diligence. Normally externally, to make sure there is a proper product market fit. What we don't want to do is invest in a great product that has to create a market. That's far too much hard work. And the other piece of interest in DD we actually do due diligence on the management team themselves. We're very diversified investors across a very broad spread. And the only correlation we have between investment outturn is the quality of the management team. So we spend a lot of time looking at them, not only within the context of their company, but just looking at them as individuals and managers. In the middle, we've got the adding value during the investment period. And what I'm really saying is where we aim to be is close enough to be supportive but not to suffocate the companies. When we come and see firms of IFAs who source investors for us, and trying to get on their panel, one of the things they say, do you turn up to company board meetings? And they've obviously got a checklist and they're ticking off, attend board meetings. To my mind, it's kind of the wrong question. For the companies I'm directly responsible for, as aside from overarching responsibility for the portfolio, I speak to them pretty much once a week. Be it the chairman, chief executive, finance director, head of sales. I'm speaking to one of those people pretty much every week. If something material emerges at a board meeting I don't already know about, I get quite annoyed. We're much closer than just turning up for a 2-hour board meeting a month and going away again. And you can see some of the toolkit and the 100-day planning we do to try and support them. And then obviously, I don't want to labour this too much just because it's my bag, it's the exit strategy. It's something we're thinking about from the outset. Giving money back is important. As a team, that's just the investment team. Someone's done some heroic maths to come up with over 200 years experience, and I suspect it's under-egging it actually, because I'm down as 25 years experience, and I'm over 30 now, but anyway. The key point is, if you look at the top line, these are the people who are leading the investments and are responsible for the investments, and they're all well into their 40s. There's a lot of experience behind them. I say they're all well into their 40s, apart from Alexandra on the right, because clearly no one actually knows quite how old Ali is. Deal flow and sourcing. We review 600 investment opportunities a year. They come down that funnel. And we typically invest in slightly over 1% of the opportunities we see. We see some cracking companies, and some of them are quite difficult to say no to, but we have to. Some of them are overpriced, some of them are imaginative business plans, should we say, but there are some good ones we end up saying no to as well, which is always frustrating. In terms of the balance of the portfolio that comes out at the end, broadly speaking, a third of the companies are technology, a third of the companies are life sciences, and a third of the companies are everything else. And there's a lot of variety in the everything else, ranging from quick service restaurants to owning a shipping company. Now let's talk about some real examples of companies we've recently invested in. Wazoku is our most recent investment. It is an innovation management software company, and it's really appealing to very large companies, and it's putting in place software and a structure such that they can gather all the great ideas from their employees and then manage the process of assessing them and turning them into improvements within their business. It's a slightly newish sector, but it's growing very fast, 30% a year, and increasingly companies are seeing innovation internally as a differentiator. Buying innovation externally is very expensive. Internally is very cheap. When we invested, they had a turnover of £1.2 million. Well, I'm saying they've demonstrated traction. They've got a great customer list. HSBC, Bristol Myers Squibb, Ministry of Defence, and John Lewis are amongst their customers, and John Lewis is one of their case studies. They rolled Wazoku software out across Waitrose, 350 stores, 60,000 employees. First year benefits that they accrued from it, they estimated at being £3.5 million profits, straight to the bottom line. It's 15 times their investment in the software and the team they created to manage the innovation. Very recent investment, we're very hopeful about it. As Essential Analytics, we invested in January this year. It does behavioural analytics software for fund managers. And by the bit that's creative about this is it doesn't just analyse past performance and point out to portfolio managers where they could have improved their performance. It analyses the fund manager's past performance and where they had missed opportunities, and then it creates what they call nudges, which will send an email to the fund manager saying, well, in these cases, you sold too late or you sold too early and it cost you this much, and you should just know that this stock that's currently in your portfolio is trading in the same pattern, you might want to think about it. Still, the portfolio manager's decision, what he actually does is just trying to point out to them how their behavioural biases might be adversely affecting their portfolio. They've done back testing across portfolios which demonstrate if their nudges are followed every time, the portfolio improvement is 94 basis points, just under 1% performance improvement in the portfolio, which for those of you aware of how active fund management works, ignoring Woodford at the moment, but more generally, a 1% change in portfolio performance is huge. This company had 1.5 million revenue when we invested, and also instructive is one of the things that really clinched this as a deal we wanted to invest in is when we were doing our commercial due diligence. And Essentia introduced us to 5 of their customers, and we went along and spoke to 5 of their customers, and very, very good feedback. But these were, of course, people who were already bought into behavioural analytics software for fund managers, because they were paying for it. We then went on our own back and found 5 other fund managers who had never heard of Essentia and weren't using behavioural analytics to help them with their portfolios. 3 of the 5 we went to speak to were so interested they asked to be introduced to Essentia, and 2 of them are now customers. That kind of clinched it for us. It also suggested that as part of the 100-day planning to improve the performance of this company, they needed to sharpen up their sales penetration because there seemed to be some unmet demand there. I'm very worried about time now. Oxford Biotherapeutics. This is kind of the exception. I've gone to great lengths saying we're growth investors. You've got to have a product on market, product market fit. Oxford Biotherapeutics is a drug discovery company. In terms of getting revenues from paying customers for its products, it's years away. We'll get milestones, hopefully, from licensing its drug candidates to big pharma. The reason we've invested in Oxford Biotherapeutics is it's got not 1 but 2 technology platforms which are generating new drug candidates. It's got 2 drugs already in clinical trials, and it's got a very strong management team. So we view it as a very high potential company. I should say it's immuno-oncology, by the way, is what it does. Very high potential. Drug discovery companies are very risky as well. It matches the potential. We feel there's an element of de-risking for it because it's got 2 portfolios. It's got 2 technology platforms to generate drugs from, but that kind of thing in a diversified portfolio of 8 to 10 companies, which each investor gets, that kind of thing has a place in it. We'd never put more than 1 of them in a portfolio like that. And I definitely need to speed up because Jessica at the back, who is with me, has just been making waving her arms at me. Another one is weeding tech, and this doesn't really fit into the life sciences or the technology bucket. This does herbicide-free weed control, which I'm going to do very, very quickly. Effectively, it's targeting municipalities with complete chemical-free weed control. The number of treatments you need a year is about the same as if you use Roundup or glyphosate. And as you can see there, the sales since we invested have quadrupled, which is what we want to see. Slight hiatus in 2018, but there were reasons for that. I don't have time to. This company is really well positioned, though, because of the main competitor is glyphosate. Glyphosate, you won't know, Roundup. It's the active ingredient in Roundup, which was Monsanto's biggest product in the world, bar none. And in 2014, the WHO came out and said they think glyphosate is probably carcinogenic. Last year, there was a case against Monsanto for £75 million in California. The cases are just building. There was another one they lost with a headline value of $275 million a couple of weeks ago. And there are now more than 8,000 legal cases against Monsanto about their use of glyphosate. If you were running the parks and playing fields for a local council, how good would you feel about putting Roundup to control your weeds on them? So that's really the play there. Just as a very quick aside, most of you probably know that Bayer bought Monsanto last summer for $63 billion. And with this wall of legal cases emerging against glyphosate, Bayer's share price has now fallen by $63 billion. A little over that. It could go down as one of the most disastrous acquisitions in history. That's an aside. Moving on, performance and exit strategy. You can see there 3 recent exit examples. Horizon Discovery by IPO, Metropolitan Safe Custody. I say the other category can be very varied. Metropolitan Safe Custody is what is safe deposit boxes, not in Hatton Garden, fortunately. And Human Race Leisure Company, which organises triathlons and 10K runs. 1 IPO. 1 sale to financial buyers, 1 to trade buyers, and again 35 exits with an average return of 1.8 times. Looking at our 2 products, EIS and VCT. I think you've all got hard copies of this, so I'm not going to go into a huge amount of detail. The differences between the 2 is the investment strategy is the same. We get invested into the same companies. It's a different tax wrapper, and it depends which suits your needs better. The EIS funds are evergreen with 4 closes a year. Calculus VCT is still open. It's got an annual dividend target of 4.5% of NAV, which has consistently met that, and with special dividends, it's exceeded it. On the EIS side, it's a 20% IRR target per company, broadly speaking. I've done the 1.8 times on the realised exits, targeting doubling your money before tax reliefs. Given that you get 30% upfront tax relief, doubling your money, including that 30p back, is almost trebling it. And on the VCT side, if you'd invested when the VCT started, £100, you get your tax relief, which was then 20%. You'll have received dividends of £85, so you'll receive, on post-tax basis, more than all of your money back, completely tax-free, no tax on dividends from a VCT, and you still own a share with an NAV of £76. So you've made a profit and you still own the share. And very, very quick summary: targeting growth, diversified portfolio, invest in entrepreneurial companies. Growth investors with lots of experience and a strong track record. My feeling is, given how much preparation I did, that didn't go too badly, but you might feel differently, I don't know. Listen, whilst you read and take in this very important information about value of shares going up and down and things, I'll take some questions. And Jessica, do you want to come and join me in case there are any technical questions where I might need a hand?
Just, obviously you've got a track record over 20 years, or 20-year post your birthday party, if you survive that. How do you source the investments? Do you go out there, locate them yourself, think this is what we're looking for, and then call, or is it all incoming of those 600 companies you looked at, and then you sift through them, or is it a mix of all the above?
It is almost all incoming, and the reason is because we're investing small amounts of money. We invest £3 million. We charge a 3% arrangement fee. That gives us a fee of £90,000 to pay the bills. If you are not even a very large, but a mid-sized private equity firm, you might write an equity check for £300 million, and that gives you an arrangement. They still charge a 3% arrangement fee, and which gives them fees of £9 million. £9 million pays for a lot of proactive research. £90,000 doesn't, unfortunately.
You still keep that regardless, right?
I still keep what?
Regardless if you invest or don't, you still keep the £90,000.
Yes,
yeah,
we do.
Yeah. But it's still much cheaper than the other option.
Yeah. No, absolutely. But no, my point is in terms of being proactive on sourcing companies, the economics, because it's very small ticket investing, don't support a big team doing proactive research. I mean, fortunately, because we've been around for a while, we know a lot of people. We've got a name in the market. I mean, we get a lot of referrals from our existing portfolio companies who obviously know people in their sector or their geographic region and introduce people if they're happy to make that introduction. We've got a brand. People just turn up on the website, etc. They come from all sorts of different places. And also, it's strange that I've spent 25 years in banking. It's a bit bizarre how I keep hearing from people I haven't spoken to in 15 years, because I think I might invest in something that they appear out of the woodwork.
But on that point, if you've looked at 600 companies, you can charge them. I do understand the amount of time and effort that's required. You can charge them each.
No.
Only if you invest.
No, we invest in sort of a portfolio of 8 to 10 companies, yes. and they get charged 3% arrangement fee on the amount we invest. The other, whatever it is, 592 companies, we assess. There's no cost. There's no charge to them at all.
I understand.
Oh no, God, we wouldn't.
I thought that was quite a good business model, but no.
It would have been a bloody marvellous business model. Should we think about that? I don't know.
You mentioned several times in your presentation the return of 1.3 times. Is that a net return or a gross return? Is that net of all tax impact or gross?
It's 1.8.
1.8.
And
excluding
tax reliefs.
So it is net of any tax relief.
Yeah.
No, it's gross. Okay. You give us 100.
So basically, it doesn't include the tax return relief.
Yeah.
So
let's be clear, because this can be confusing. If you give us 100, on that statistic, we give you back £180. In the meantime, of your original 100, the Chancellor has given you back 30. So your net cost is 70, but we're taking the 1.8 is calculated off the 100, if that makes sense. And the 80 profit is tax-free. It's great.
Good evening. You were talking about the whole tax setup of the EIS scheme VCTs being organised for SMEs. And I know there's quite a wide body of opinion that thinks that it looks as though you are genuinely following that. But a lot of money in this sector is going for property and other low-risk or quasi-property that they can get away with under the rules. I wondered what your thoughts were on that for the sector as a whole, and secondly, and perhaps more importantly, how you see government policy going in this sector, because I think there was a lot of thought that some of the tax benefits might go last time and they didn't, and I wondered how you looked at that going forward in terms of the tax incentives being kept.
I think the change has already occurred.
Yep.
Two Novembers ago. I mean, there was... listen, effectively, it's a government tax incentive to invest in SMEs, and the government are doing that because there's a huge amount of economic evidence that investing in SMEs grows the UK economy, and investing in FTSE 100 companies doesn't, frankly. It's worth noting almost every country in Europe has some form of governmental incentive to invest in SMEs for exactly the same reason. Calculus Capital has always been a growth investor in entrepreneurial companies. You're absolutely right that there have been others who are looking at the tax benefits and then working out ways to deliver those tax benefits to their investors with the lowest possible risk. And an example was renewable energy, solar, where effectively you could get EIS tax relief in order to build a solar farm which had government guaranteed revenues for the next 25 years. So revenue turned around and said, well, come on, guys, you're kind of double dipping on our generosity here. And so they shut that off about 4 years ago. And then 2 Novembers ago, they cut off some of the other abuses where people were investing in limited life companies which had guaranteed revenues because they'd already pre-sold the rights to what they were going to develop, and there was very little, if any, risk. And at which point the Treasury sort of turned around and said, and this direct quote from someone at the Treasury said, listen, guys, we've had enough of playing whack-a-mole. You're all very smart, and we give you a set of rules, and you keep pushing the envelope and finding a way to not deliver our policy objective. And so they introduced what's called a growth and development test, and said up front, we know this is tax legislation, and so everything should be completely objective, but this is a subjective test. You have to convince HMRC this is a genuine entrepreneurial company that's going to grow. And if you can't convince HMRC, you're not getting EIS benefit. And they said, because we're just not paying whack-a-mole anymore.
Thank you very much.
And do we have time for one? Just
one very quick question.
You haven't mentioned any write-offs. I've got VCTs, and you do get a number of duds. How's your record on that?
Broadly speaking, it depends where you're investing. If you're a VC investor, which we're not, effectively 80% of your companies are going to be zeros, and you get your portfolio return from the other 20%. If you're a big buyout house, you expect very few zeros and returns from most of the portfolio. With us, we sit in the middle. It's about a third will be loss-making investments. About a third will do okay, make, say, your money back to a 50% profit, and all of the portfolio return comes from the remaining third. The important thing about the 1.8 times, that's an average, it includes the zeros. And there are zeros and loss-making investments in it. We've had 35 profitable exits, which came to 1.8 times. It includes,
The failures.
is it 14
30.
loss-making? 30, that 35 includes 13 loss-making investments, and it still comes out on average at the 1.8. I will be around afterwards to answer any questions, and if it gets too technical, please find Jessica. Yeah?